So I'm very sure that you would have attempted 11.5. At least I have to be sure, right? So, yes, no, yes, okay, fine. At least I have an overarching yes. So, very happy about it. Now, so that sort of completes, winds up our cash flow statements. Most of it, you would have got it right. I'm very sure you guys would have got it right. And it's a very simple problem. Whereas what you see more and more is only the cash ledger that is there in that 11.5 exercise. So you guys would have done it. In case you still have a problem, just get in touch with me or Pratik and we can send you the solutions also. Not an issue. Now, what we have seen is normally a very simple P&L, a very simple balance sheet, etc. We are basically looking at an entity or a corporate. They will have a balance sheet. They will have a P&L. They will have a quarterly sort of balance sheet and P&L, which they would sort of give it out to all the stakeholders, which they will publish, etc. But you have what is called as an annual. At the end of every financial year, there is a P&L and a balance sheet and a cash flow statement, which is normally what is called as audited, which is verified. There are chartered accountants, basically certified chartered accountants, practicing chartered accountants who basically certify, who sort of go through all the accounts out there and basically certify. That is what we call it as audited financial statement. And this audited financial statement is what is published in what we call it as the annual report and circulated basically to all the stakeholders, predominantly the equity holders, etc. They get to know about the health of the company. So that is what. Now, I'm not going to the entire annual report. Entire annual report will have director statement, will have what is the plan of the company, what is the company doing, etc. A whole lot of things. Since it's an accounting class, we will restrict it to only the finance part of it. And I've culled out basically the finance part of it of Maruti Udyog out here and then put it out in the manual. That is, just pick up the page which says consolidated balance sheet. Consolidated balance sheet out there. You can just pick up, they will say consolidated. Page number, there's no number for this, page number is 196. The font is quite small, so you got to be a little careful in not missing out any of those. So I need to have my specs on, otherwise I can't see this, obviously. Right. So now, you basically see there is something called as, let us go step by step on this. There is something called as consolidated. Today it's going to be a lecture. I'm not going to use much of the board. It's going to be consolidated. Now, what is this consolidated? Please note, every entity can have what is called as a main entity, and there could be hiving of what you call it as subsidiaries and etc. out there. Now, I will have to prepare a balance sheet and a P&L which gets audited for each of these entities out there. That is, each of the subsidiary entity that I have hived off. For example, I would say, I could have a main manufacturing unit. I can do a backward or a forward integration, and I will hive it off as a separate company out there. I can hive it off as a separate company, but the main holding company can continue to exist. Now, I can create n number of entities like that. Now, for each of these entities, I need to prepare what is called as a P&L and a balance sheet, etc. Now, when I say consolidated, I am sort of adding all that. You can even look at what is called as a P&L and a balance sheet for each of these entities. And as well as, for example, this could also possibly include what happens is your investment in joint ventures, etc. You might have joint ventures, for example, for many of the ancillaries, etc. So what happens? Only that portion, consolidated for your kind of holding. That is what we call it as consolidated balance sheet out there. Now, beyond this, attendance you can take care of later. No problem, no worry. That's not necessary today. It's an online class, right? So, it's online class. You don't have to online, but we are all face to face out here. Now, at the bottom of it, you have a lot of aspects listed out here. That is, who is the basic auditor who has basically audited this financial statement? If you look at here, it's Deloitte Hawkins and Sells. Out here, then, from this, on behalf of this company, that is auditing company, who is the partner who is basically signing this particular, that is who's certifying this particular aspect out there. Why It is necessary because you got to have the partner who is certifying this entire accounts out here. That is partner in the sense he is not going to go through everything. He is going to have your audit clerks and everybody out there. They are going to do it. But he is finally going to certify this whole thing. That is whatever is the financial statement out there. Why? Because he is taking responsibility. Go back to your Satyam. What happened? Even the auditors were basically in trouble because they had certified what were the financial statements that are submitted by the company out there. So the auditor and the partner certifies. Now, can the same partner certify for time immemorial? No, normally 3 years. Normally 2 or 3 years. Am I right? You are from Deloitte, right? But you don't know. 5 years. 5 years the firm changes. Normally every 5 years the firm changes. The partner normally as a best practice they change the partner every 3 years. Not more than 3 years. They try to retain a partner. But best practice is they do that, but every 5 years you got to look at a different set of auditor. Now, this will be there in the main 3 pages out there. That is 196, you see the balance sheet. 197, you will see consolidated statement of P&L. And then 190, what do you call it, is 199. If you look at, you will see what is called as consolidated cash flow statement. Statements that are required out there. Right, we will be going back and forth pages. So let me make that very clear. Now let us look at it. Now what happens? There is a list of assets given. Let us go back to page number 196. There is a list of assets given. There is a list of what is called as equity and liabilities given out there. It's all in small font. You will have to spend a little carefully. You will have to look at it, etc. Now let us look at equity and liabilities. Let us not move beyond that. Let us look at equity and liabilities part of it. If I look at equity and liabilities, what is it? Basically, your liability portion of the balance sheet, that is equity and liabilities, is all your equity, debt, etc. The whole lot of things out there. Now, when I look at the equity and liabilities, it says equity, in equity share capital, whatever is the amount out there, that is 1510 in million. 1510 millions is there. And then that is for the current year, and there is also a statement for the previous year. Every annual report that you will basically look at, it will always have yearly, it will always have statements for minimum 2 years. Some companies even go up to 3 years of financial statements, but normally 2-year financial statements is what every company will have to publish, because you got to look at comparison, number 1. Number 2, sometimes post audit there could be some changes also, because and that could also happen very rarely. So if that is also happen, that is also basically reflected out there. So normally it is basically for 2 years out there. So in this particular case, it says equity share capital, and then there is something called as other equity. But this does not give you any information on what is the number of shares, what is the face value of the share, etc., etc., etc. out there. What is how many shares has the company issued? What is the face value of the share? Is it 1 rupee? Is it 10 rupees? Is it 5 rupees? Is it 100 rupees? Anything, etc. So that is where your balance sheet as such, that is 1-page statement out there, does not give you a great picture. It just gives you some numbers to basically look at, and it can help you raise questions. It is not a solution by itself. It can help you raise questions out there. Now what do? There is something called as, if you look at the second column out here, the first column is the particular. The second column out there is what is called as notes. That is what is the word used out there. Now, some companies will use it as notes. Some companies will keep it as schedules. Either of it they will use. So, if you look at the schedule, it says schedule number 13. Now, just move to schedule number 13, which is there in one of the subsequent pages. Which page, sir? 221. 221. We should have a copy of it. Ask him to get a copy. At least for this class. No. Ask him to get a copy. You will have extra copy? Yeah. Just get 1 copy for him, as for this class alone, so they can help me in that. Let them use it. If you look at 221, there is something called as 221, page number 221. There is something called as equity share capital, there is authorized capital, there is issued capital, there is subscribed capital, there is fully paid capital, the whole lot of things. It looks a little bit confusing for you. Now, let me explain what is each of these. Now, authorized capital, when we say authorized capital is the amount of money or the number of shares that the company can issue in its lifetime. I repeat. Authorized capital is the amount of number of shares. In this particular case, if I look at the authorized capital is 3751, followed by about 6 zeros of rupees 5 each, that is what the number of shares that this particular company can issue in its lifetime. In its lifetime? Yes, as of now, in its lifetime. That is, out of that, for example, let us take a very, very simple example. Keep looking at the chat box. Let us take a simple example. Imagine I start a company and I need about 1 lakh shares out there at $10 each. And that is the growth. That is 1 lakh shares of 10 rupees each. That means it's about, you're talking about 10 lakhs out here. Now, that is what is the requirement I have envisaged for the company for whatever time period I can see forward. In the sense, whatever time period I think this company is going to be there, as far as I can imagine, I can extrapolate, I can I can foresee whatever is it. This is the kind of money that I might require. 10 lakhs is the kind of money in terms of capital I require. But I don't require the entire 10 lakhs as of today. Now, this becomes what is called as the authorized capital. Now, I don't require the entire 10 lakhs as of today. Out of this 1 lakh shares out there, I can issue 25,000 shares to the public. I am issuing, that is, I am trying to collect as of today only 25,000 shares from the public out there. That is, I will issue 25,000 shares at $10 each. That is what I call it as I issue to the public. I say public can subscribe to it. Now, out of this 25,000 shares what I have issued, what happens is I might get subscription for about 24,750 shares at $10 each. That is what we call it a subscribe. People are subscribing to it. And what is called as, now then the next aspect that comes in, what we typically call it as, they have subscribed to it, but they have paid part of the money, or they paid the money, but what happens? There could be some transactions, sometimes what happens is the transactions don't go through, or what happens, you are not able to collect the money from them, but finally, what happens? I have received money only for 24,500 shares at 10 rupees each. That is what we call it as paid up capital. That is what we call it as paid up capital. That means that is the money that I have received. That means I have issued only 24,500 shares. The other 75,500 shares, I can issue it anytime in the future. Now, do I have to issue the whole thing in one shot? No, I can split it. The 75,000 I can issue in 7 times also at the rate of 10,000 shares or 15,000 shares every time I issue. It's up to me. Depending on the need, I will keep on issuing these shares. So, when we say, one second sir, when I say authorized it's in its lifetime. Now, second question that comes in here is, can authorized capital be changed? Yes, because you are looking at a company which is going to be there. You have envisaged for the next 20, 30 years or 40 years, and this is what I see. And after that, and I am looking at further expansion. Then what happens is I might go in and sort of pass a special resolution, and then even extend my authorized capital. But it doesn't happen on a regular basis. It happens once in a blue moon there. Part of that could be subscribed. Sometimes you see oversubscription, the entire thing is subscribed. And everybody would have paid up also. So in the sense, sometimes in this particular case, you see, issued, subscribed, paid up is exactly the same in all that. Right? Now, what is relevant to us? Relevant to us is only paid up capital, because what happens? Accountants, you are looking at cash, money is what the paid up capital. How much have you collected? That is all. Money is the paid up capital, is the share capital which you will consider for all your analysis. With you on this, so far so clear? Yes sir, your question.
This subscribed is 24,750, whereas paid up is 24,500.
Yes sir.
That is, the decision will be taken by the...
Not necessary. People have subscribed. In this case, I have kept everything below what is called as your my issued capital. It can be over. In this particular case, people have put in the applications out there, but I am not able to get the money. They have said they have what is called as they have given what is called as an instruction for money transfer. Money is not coming forth. Somewhere they have made it could be anything. Now the other aspect what you are worried now is what you talk about is oversubscription. Now I issue 25,000 shares away from this notebook or whatever manual. I am going a little bit now. When I am talking about I issue 25,000 shares which is going to continue out there, but I get applications for about 75,000 shares. I get applications. So what happens? It is oversubscribed 3 times. It is oversubscribed 3 times out there. Then how do I do the allotment? In this particular case? Please understand, in this particular case also allotment is possible. There are multiple ways of doing the allotment. We are not even talking about the book building route as of now. We are talking about the very simple fixed price issues out there. We are talking about fixed price issue 10 rupees. We are talking about an issue which is at par. We are not even talking about issues which are at premium number 1. Nor am I talking about any issue which is basically what you call it as a book building route, etc. We are Park yourself right here, sir. I think he has a camera and it might be difficult. Now, we are looking at this oversubscription, which is about 3 times in this particular case. Now, there are multiple ways of allotment. I am very sure people who are already investing in equity would have understood, would have known this. But let me repeat. One of the way is very simple way. I just draw lots and then allot it. Second, I do what is called as a pro rata basis. That is, it is 3 times oversubscribed. For every application, what is called as I will give them 1/3 of what they have applied. That means everybody gets the shares out there. I can do it. What we call it as pro rata. Or I can just do simple lot basis. Either of it, I can basically adapt in the process out there. There are other ways, book building, etc., etc., etc. Let us not even get into it as of now. Okay. In this particular case, if you look at now, coming back to the manual, page number 221, if I look at it, equity share capital, there is the authorized capital, there is issued, paid up, fully paid up capital, and this is the money. That is, your company is eligible to collect about 18,755 million out there in the authorized capital. But as of now, you are collected only 1510. 18,755 is a huge, what you call a million. Out of that, you have collected only partly out of it. And anytime the company can, what is called as issue, do a private placement. They may not even issue to your general public. They can actually do a private placement. Private placement means I can negotiate with a large investor and basically increase my share capital. Sell the shares and collect the money from him. That is what we call it as private placement out there. These are all, I am putting it very crude form for you guys to understand. I am not even getting into the technical definitions of all these things. Yes, sir.
Sir, here in this case, 75,000 share issuing at the rate of 10 rupees.
Yes, sir.
Let's say the authorized capital is already 1.5 lakh.
Authorized capital is 1.5 lakh. I agree.
If the oversubscription is 3 times, can the company go back and try issuing more share for the?
At this stage, what you have normally issued is basically all these numbers. Before you issue, there are regulators who will sort of approve what is called as your what is it you require. You cannot do it. You cannot amend it at that stage. Maybe you can issue it again later 1 year. When you got oversubscribed, doesn't mean anyway I got the money, I'll use it. It doesn't work that way. Because your money what you receive is also based on the plan for your investment now. Because if I receive, whereas when I require 25,000, that is 25,000 into 10, whereas when I am receiving 75,000 into 10, that means I have an extra 5 lakhs out there and idle money doesn't grow. So you don't do it.
So there is some regulation by which.
Of course, yes, there are regulations because you are you sort of take an approval for going for an IPO. What is the quantum of IPO you are going through, and you cannot just go back and amend it. It is not allowed. Yes, please.
Sir, Rishabh is asking, is preference shares also part of this authorized capital?
Preference share is not part of this authorized capital, sir. Preference share is different. This is only, we are talking only about equity, Rishabh. Yeah.
Authorized share capital is allowed by the company or by the regulator?
It's by the company, sir. You decide based on the plan what you envisage. For example, if you look at the Asian Paints balance sheet, go back and look at the Asian Paints balance sheet. If you look at the Asian Paints balance sheet, you can just Google and see their authorized capital, they've already reached their authorized capital. Because when they started in the garage, they did not envisage such huge kind of growth out there. They've already reached their authorized capital. Now, will they go back and expand their authorized capital? Well, they have to some stage or the other. That is why some of them are just holding on to Asian Paints out there because their reserves and surplus is much more than the issued paid up capital itself. So idea is the day on which you are going to enhance authorized capital, this reserves and surplus will become partly bonus. You shift it to bonus, right? That is what will basically happen. That is what people are holding on waiting, but you don't know when it's going to happen. So let's not even get into speculating that. I'm not giving you any tip out here.
Sir, small
Yeah, sure.
To increase the authorized capital, do we need to really move the fund from surplus and reserves?
No, there is no authorized capital. You are not doing anything. Authorized capital is just a number. There is no cash out there, right? It is only authorized. You are allowed.
Do you need to have that fund?
No, you don't have to because you can increase authorized capital. That is, you envisage the plan. You are able to put up a special resolution. That's a long-run process. That is not such an easy process. It happens once in a blue moon.
But the regulators don't question.
Regulate, that is what you have to pass a resolution. You have to get it approved. I mean, there is a whole lot of legal process out there. I'm not even getting into that.
I think it has to be justified.
It has to be obviously. One cannot just generally have an obnoxious number as what is called as authorized capital. Not possible, sir. So equity share capital part of it, very clear. Now I move to what is called as Schedule 14. The same page, 222. Next page. There is something called as, if you look at, you go back to your page number 196, after the equity share capital, there is what is called as other equity. There is something called as other equity. What is this other equity? Normally, we will call it reserves and surplus. That is what I have basically told you. They call it other equity. That is basically why other equity? The entire money belongs to whom? Equity shareholders. That's all. It is other equity. It's some part of equity denominated in shares, some part of equity not denominated in shares, but held under various heads out there, like your reserves and surplus, capital redemption reserve. They have a whole lot of things out there. General reserve, capital reserve, share premium reserve, securities premium reserve, retained earnings, cash flow hedging reserve. Now, all these reserve is always culled out of profits. Profits belong to whom? Equity holders. When it is culled out of profit, unless until otherwise utilized, belongs to the equity holders only. Some part of the money belonging to the equity holders is denominated in the form of shares of $5 each. That is what you saw, the first part. The second part, not denominated in the share, not denominated in the number of shares, but under various heads, but belonging to the equity holders. Some balance sheets, annual reports will call it R&S, reserves and surplus, and they will list out the same thing. Some of them call it other equity. It is just the name. That's all. Because the money belongs to the equity holders. Am I with you on this? So far, so clear? Any chats? Nothing? Perfectly fine. How many of them are there online?
21.
21. Okay. 20. That is including him. Including Rajesh is 21. Rajesh is not a student. Don't worry. Now, we move on further. Equity attributable to the owners of the company. Non-controlling interest. I'm talking about page number 196. Just fold it and keep it. So you got to keep going back and forth. I just folded the head and kept it because you got to keep going back and forth. Page number 196. If I look at page number 196, I basically see this what we call it as non-controlling interest out there. When I say non-controlling interest, it is schedule, that is equity attributable to the owners of the company out there. That is what we call it as schedule number 15. If I go to schedule number 15 out there, which is in page number 224. The various listing out there. That is where all your head JJ Impacts Private Limited, your etc. and so on and so forth out here. You will see that balance in the year, share a total of the comprehensive income for the year and balance for the year. That is basically you have what is called as your owner's equity in the that is equity attributable to the owners of the company or non-controlling interest. Let us just leave that as of now. Let us not get into the explanation because that could sort of throw your other understanding out of gear. We'll come back to it at a later stage when we are looking at it. Let's go to page number 196. You have total equity out there. Then you have what is called as liabilities. In the liabilities, you have what is called as non-current liabilities. First aspect is financial liabilities. When you say financial liabilities, some companies will denominate it as, instead of non-current liabilities or instead of financial liabilities, they will take it as long-term debt. That is the word they might use. In this particular case, you have written it as that is financial liabilities. This is again what is called as the usage of the terms what you use. Some case it is what is called as your long-term debt. In this particular case, it is financial liabilities. When you look at your financial liabilities part of it, in this particular case, you will actually go back to your first thing is borrowing, second is provisions, third is deferred tax liability, fourth is other non-current liabilities. You have the 16 schedule number 16, 18, 19 and 20. Let's go to the schedule number 16, 18, 19 and 20. Before that, even if you look at page number 222, before that, even if you look at your page number 222, we talked about other equity, capital reserve, general reserve, security premium reserve, everything, right? When we talked about other equity. Please note, this capital reserve, what was it last year? What is being added this year? And what is the total capital reserve this year? Or what is the general reserve last year? What is it added this year? That entire details is there. 14.1, 14.2 and 14.3 and so on and so forth out there. Till about 14.7. For each of these, they have given the explanation. What is it at the beginning? What is the addition this year or deletion this particular year? And what is the balance what you have? And that consolidated goes into schedule number 14 out there. This 14.1 to 14.7 gives you that detail out there. With you on this so far? So far you are able to get a hang of what I am communicating, right? You are able to get a grip of it. Now I move on. What we call it as we are looking at schedule number 16. Page number 225. Now in this particular case, schedule number 16, page number 225, you see that non-current, unsecured term loans from banks, current, unsecured, what is called, that is look at only the non-current because we are looking at only the non-current part of it, because only the non-current part of it is basically listed out here in this particular case, in this number out here. We are not looking at the current. Current will come back later. We are looking at non-current. Non-current means which are basically long-term liabilities. Now, what is this short term? It just says term loans from banks. Please note, when I indicate in class 1, balance sheet is something which basically gives you all the information but does not give you the vital information out there. This schedule balance sheet, if you look at just that page, it says no, it says financial liability, some obnoxious number. Now, if I look at the schedules, it has split those schedules out there. It says term loans from banks. You still do not have information on from which bank, what is the amount of term loan, what is the interest rate on the term loans. It depends. Some companies would give those schedules, those as information also in the schedules. Some companies may not give because it is not mandatory to give those information also. So even if I look at all this, I will still not be very clear. Supposing you have a very high cost loan. Imagine you have a very high cost loan. You have high cost loan in the sense you have taken a loan from somewhere where the interest rate is very, very high. That means what is happening? Your liability in the future is going to be extremely high because you have already taken a loan out there and you got to pay interest in the future extremely high. So you don't have that information. So if I feel that balance sheet and P&L, I can make the complete analysis and analyze the health of the company and decide Well, you can do it to a certain extent only. You cannot completely get a grip over that particular company out there. This gives you pointers for you to ask questions. This gives you pointers for you to ask questions. Am I with you on this? So in this case, it says term loan. What is the amount of term loan out there? That financial liability, if you look at the schedule out here, it just says financial liability borrowings out there. What borrowings? Borrowings from where? It says borrowings from banks, and all these are term loans. Term loans means long-term loans. To the extent of what? 100. You can always compare what was it the previous year. If you look at what was it the previous year was 0. This year is about 100 million in this particular case. Now, that raises your antenna. Moment I have had a 100 million loan, what have I used it for? There should have been a corresponding increase in the beautiful, at least in the asset. Somewhere you must have invested out there. Let us look at it a little later. I am not even looking at analyzing all that now. I am looking at, because these are the questions that basically has to come to your mind out there. Am I with you on this? Now I move on further from this. There is what is called as schedule number 18, because we looked at schedule financial liabilities in this particular case. When we look at the financial liabilities out there, we look at borrowings, provisions, deferred tax, etc. Schedule 16, 18, 19, 20. I am looking at schedule 16 out there. Now next I go to schedule 18. I create various provisions for the employees, retirement allowance, etc. The details of that provisions what I created, it's all there in schedule 18. Employees retirement, because that is a liability which you got to pay. You got to create a provision for it, because simple, in your company, out of your salary, you contribute part of the amount for retirement benefit. Your company contributes the equal amount also for your retirement benefit. Whatever, you might call it PF, you might call it by different names, etc. I am not even getting into that. But there is a liability on the part of the company that they are also putting in some money on your behalf. No, that is all part of the liability. That is all they are creating a provision out there in the process. That is all what we call it as that. It just says provision. Provision for what? In this particular case, it says employee benefits, retirement benefits, warranty for product. Please note, when you buy a Maruti, you are buying it a year's warranty out there. You are buying it with a year's warranty almost. And there is a damaged manufacturing defect. You start driving and the engine just comes out, manufacturing defect, then they got to make good for it. They are sort of replacing or whatever they are doing. Let's not even get into that. No, I got to create some provision. Now, how do you make the provision? You normally make some scientific estimates out there. Now I'll say, my defect ratio, normally I am about 99.9%. There is no claim out there. I have a 0.01% claim. That is the kind of claim what I have. Be going by history and going by my kind of technology what I use. You create a provision for that particular amount out there and say that could be part of my liability in the process. With you on this? Any questions at this stage? Today is theory again. So morning 9 o'clock, I agree. It's a Sunday morning is difficult, but today is going to be theory. Sure, clear on this? I'm not looking at the current part of it. Then I move to schedule number 19, what we call it as your deferred tax balances. The whole lot of things are there. Now, first of all, let me explain what is this deferred tax. Page number 228. Now, first of all, let us understand what is this deferred tax, what is this, etc. Deferred is nothing but an English word. Deferred means postponing it, you are paying it later. That is all. Very simple. Imagine, away from this discussion of this balance sheet, you are setting up a manufacturing facility in Chhattisgarh or in Arunachal Pradesh. And when you are setting up a manufacturing facility in Chhattisgarh or Arunachal Pradesh, what are you trying to do? I am trying to create what is called as the employment out there. I am trying to create what is called as there is a prosperity and growth in that particular region, etc. and etc. etc. Now, there is what is called as direct employment. There is also what is called as indirect employment in the process. Now, to enable that or to encourage that, the government gives you what is called as, there could be a possibility, they could just say tax holiday for 5 years. That is, for first 5 years you don't have to pay any tax. All your STPI, whatever which is there in your software technology park, you have some kind of a leeway around that. I don't know the exact details of it though. Or they can say there is a deferred tax facility what you will have. Deferred tax facility, when I say that, first 5 years you don't pay tax, but you calculate and keep it. Whereas from the 6th year to the 10th year, or any number, what they will say, you not only pay for the 6th year to the 10th year, whatever tax applicable for that year, the past tax also you can pay bit by bit and clear it. Perfectly alright. At least first 5 years I don't have to pay tax, and that kind of cash is there with me, which is basically adds to my capital in the process of the working capital in the process of the. So these are all some kind of a deferred tax benefits out there. Number, that is one part of it. The second part of it would also be what you call it as, in the today there is a GST credit, etc. what you are basically trying to get out here, because you are paying at one shot. At every shot, when you are at every stage when you are paying this, when you are paying the taxes out there, the good, imagine a good, if it passes, if the channel has about 8 different what you call stages through which it passes, and at every stage you are paying tax, the amount of tax what you would pay will be much more than the cost of the product. So what happens? You get a credit. You can basically claim it back in the process, because that kind of a tax. That is all this basically around. Deferred tax means anything which is basically deferred out there. So you have the benefit, and the details of it are presented out here. Anything you want to add? Nothing. Okay.
So it means we have to pay, but in
They have to pay, but yeah, whatever it is, there could be some arrangement in terms of deferring that tax. Tax holiday means there is no liability, no? Because you have to pay only, it's a liability, right? Yeah, sir.
Something called deferred tax assets.
Yeah, we'll come to that. We'll come to that as we go along. As of now, hold it. We'll come to that when we go along in the process. I go back out here. Yeah.
So deferred tax liabilities, will it become a long-term liability?
It sometimes what happens is depends on the time period. I say I have a 5-year tax holiday, and I'm going to pay it only later. Then basically we are looking at long term. Short term is normally what we look at is which is within a year. For example, I say first 3 years there is a tax holiday. You pay it from the year 7 to year 10. Naturally, what happens? It can become a long term in the process because it's more than a year. Am I right, Malika? Okay, fine. Now we go on. I thought you were asking the road for a minute, but anyway, good. But if you had asked me for it out, I would have thrown you out of the class. Now, beyond that, we have what is called as total payables after borrowing. Again, I am going to page number 196. I'll give you guys a break at 10 o'clock for 2-3 minutes. I know, because today's class is a little dry, and I see a little, people are a little uncomfortable, but we have to go through this because you got to understand when you are basically looking at what all you will get. Many of you may not even look at finance or accounting out there, but all you will get is you will get only this bunch. You will get, as manager for decision making, you will get only this bunch, and unless you know how to interpret this bunch, there is going to be a problem. So we have to understand how to interpret this bunch. We will learn how to work out, how to calculate the P&L, how to do a cash flow statement. All that makes no sense. Basically, as a manager, you will get this bunch and you need to interpret this bunch. And to interpret this bunch, you got to know what goes into it. That is where we spent about, in the last 7-8 classes, we spent about what goes into it. Now, this is the main aspect what you will get as managers. Because as you grow in the ladder, corporate ladder also, when you are looking at any decision making, you are looking at decision making only on this entire bunch out there.